Okay, hi and welcome. And today we're going to do a quick look at a snarky post I made yesterday about a property company in China called Sunac. Okay, Sunac is one of these big developers that has, I don't know, a couple hundred or at least tens of billions of dollars of debt. We can here use Bloomberg to look at their financial statements. And their enterprise value is around 60 billion, of which now, they're dead. They only had 3 billion of market cap when they last got suspended. That was down from 26. They now have 47 billion of debt. They say they have 16 of cash, but we'll see. If you're trying to figure out what's going on with these bonds from the stocks, you'd have a tough time. You'd have to go into Bloomberg, you'd have to go here to Rels, you'd have to go down to corporate ticker, and then you'd have to kind of scope around and add up a bunch of these. You can see they're all consistently around $13. So let's look at Rose. In Rose, we can do the same thing. And while it's happening, I'll load the tweet. Right, and here's the tweet. And the tweet's about, S&P and Fitch and Moody's all deciding to lift their ratings basically when it was too late for investors, when investors had already taken the pain. So we can check that here. We can just say, well, March 24th is when S&P kind of begged out. April was Fitch, and then it took Moody's until yesterday, 10/10. So let's go look at what that looked like in Rose. Well, back in March of this year, you can see the bonds were already down 50%. The stock was already down 85%. That then peaks out in April with the bonds down 64, the stock down 90, and now we're here where the equity is no longer trading. So it's worse than a drawdown because you have that capital locked up. You can't get it out. And the bonds are, now down 85%. And just to quickly show you how that works in Rose, we organize a big map, in this case a map of probably 2,000 bonds. We then filter it based on Sunac, get it with these ones, and we just literally look at the change in that and average them all together. Average the prices. So it's a little bit dirty, but it kind of works. And just to quickly show you how that works on the rest of the platform, we can add up all those individual property companies and look at, for example, what is the ratio of the market cap for these property companies to their assets. Another form of leverage. In a post the other day, I looked at market cap as a percentage of RWA, risk-weighted assets for banks. This is kind of a version of that, although who knows what the risk weight on their balance sheet is. Definitely more risky than government bonds. And you can see it's already down to 9%. So the whole sector, just forgetting the losses that needs to get worked through the system, are now at the most they've ever been. And our loss estimate is about 1.1 trillion. Coming from what you'll see is a bunch of different, probably going to blow up this notebook, honestly, a bunch of different data sets underneath this. That's actually what it's going to do. So what this does is it goes and adds all the changes in the individual 2,000 bonds and applies them to all the assets for the 200 property companies. And it works, but if you try to look at it in rows, unfortunately there's too many objects and it will crash. So